What are the best investments for retirees that will keep that cash flowing forever? This is very likely the most common question I get on this YouTube channel. Many retirees lean towards higher yielding portfolios, which makes sense, and covered call ETFs align well with that strategy. There's a lot to love here with a combination of some juicy dividend yields along with quality holdings that are based on some of the best underlying indices in investing. My two favorites are JEPI and JEPQ. Today we're going to explain how valuable these ETFs can be for retirees looking for cash flow. But, and there's always a but, we'll also be touching on why dividend growth ETFs like SCHD, DGRO, or VIG are better long-term bets for most retirees. If you're new to the channel, welcome. My name's Jeff Teeples, and here we aim to grow your wealth with simple, time-tested solutions. Please smush that like button, subscribe if you haven't already, and drop me a comment below with your thoughts about any of the ETFs we discussed today, or anything else that comes to mind as you watch the video. It's time for the Sunday shoutouts for the 5 new members. A huge thank you goes out to Clay Jeffries, Trev Perry, Josh Whitezig, Devish Shengari, and Cindy Hua. And I apologize if I slightly butchered any of those pronunciations. I tried my best. You can find the link to the Google Sheets under the Memberships tab, and also feel free to hit us with a few of the custom emojis in the comments below. Let's grow. Setting the stage. Every ETF we discuss in this video is a quality investing option depending on your goals. I'll be saying stuff like this is superior growth, or that one's yield trumps the other option. Know that I'm simply comparing the pros and cons of each, and I'm not saying that any of these options are bad. I think I confused a lot of viewers with my first video comparing JEPQ and SCHD because I went with extreme scenarios. I talked about going with 100% SCHD to show the superior dividend growth. And then on the flip side, I discussed going 100% JEPQ to show how powerful the yield is. In reality, you're probably going to want a few of both of these options or options like them in your retirement portfolio. I'll be sure to throw in a few more balance situations in this video once we dive into the dividend projection tool later on. The power of qualified dividends. I often mention the power of qualified dividends in passing without diving into the details of the tax implications. Let's cover this before moving on to the specific retirement situations. Taxes are important to understand for any retiree, and believe it or not, they're not overly complicated. A dividend will usually be paid as a qualified dividend as long as it's paid by a US corporation and you've held the stock for at least 60 days. That's the two main things you have to tackle. As long as you're not trading this stuff actively, any ETF that holds all US companies like an SCHD or a VU or a DGRO or anything like that will pay qualified dividends as long as you're a buy and hold investor that's not actively trading these things. This top tax table right here is the long-term capital gains and qualified dividend tax table. So as you can see here, if you're married and filing jointly, if your taxable income is $94,000 a year or lower, your qualified dividends from things like SCHD will be taxed at 0% in your taxable account. And if you're single, that number is $47,000. And remember, this figure right here is your taxable income. So the $29,200 standard deduction can actually be added to this. Any income you earn as a couple, $123,000 or lower, will really get taxed at 0% because that standard deduction is your friend. So this is even more generous than it looks. And then you can see most other people, unless you make a lot of income, unless you make over $584,000, you'll be in the 15% tax bracket for qualified dividends after you exceed this $94,000 threshold. And at the bottom here, we have our 2024 federal tax brackets. So this is where these income amounts, you can see this $94,000 is about the same here for the 12% tax rate as 0 up here. And then you get into the 22 and 24 and 32% tax bracket in these taxable income ranges, whereas this huge chunk, so basically from 22% beyond that 94, all the way down to mid 35%. Instead of paying this amount of taxes on qualified dividends, you'd only pay 15%. So unfortunately, the JEPIs, the JEPQs, the REITs, interest from high yield savings, money markets, they fall in this camp. This right here, the 0% for anything under 123,000, including that standard deduction, is what makes these dividend growth ETFs that pay qualified dividends extra special over the years. A less known advantage of qualified dividends is that they will never push you into a higher tax bracket. They do not affect your marginal tax rate or your federal taxes at all. Much like long-term capital gains, they're accounted for entirely separately from your federal taxes. Let me throw out a quick example to explain this with the real life situation. Let's say that a retired couple receives $65,000 a year from Social Security, maybe a pension, and other sources of income. This means their taxable income, their box one income, will be about $36,000 after taking the standard deduction from their earnings. And of course, there's a little more to it than that in reality, but we'll just use nice, easy round numbers in this scenario. And the standard deduction and that base income is most of the story anyway. Okay, now for the next step, let's say that that couple receives $35,000 of dividend income from SCHD, and they receive another $10,000 of dividend income from DGRO. So that's $45,000 of incoming quality dividends that year. Receiving dividends always triggers a taxable event. So whether you reinvest the dividends or take it out and use it to have fun and live on, either way, it triggers a taxable event. But because they're qualified dividends, in this situation, you will pay $0 for that taxable event. That's the beauty of qualified dividends, which again, fall in the exact same category of taxation as long-term capital gains. It does not get better than qualified dividends. Okay, let's take that same couple and get a little more extreme here. You know, they built up their portfolio when they were working 401k and other things. They got to 5, 6, 7 million. Let's say they have that same $65,000 of, Social Security, pension, and other sources of income. This is their ordinary income for the year. But now let's say they receive $150,000 of qualified dividends. Again, just to be clear, this $150,000 of qualified dividends will not affect their federal taxes, their normal tax stuff at all. It's as if it doesn't exist and it's accounted for separately on the back end after filing all the taxes. So their marginal tax rate remains the same. They're in the 12% tax bracket. They would pay $0 on the first about $58,000 of dividends. And then they would pay 15% taxes on the last $92,000 worth of dividends. That's because their ordinary income, that's $65,000, less the standard deduction, plus the first $58,000 of dividends, got them to that $94,000 threshold. And then within that special tax table that we reviewed earlier, the next whole bunch goes at that 15% tax rate instead of the 0% tax rate. But again, I can't emphasize enough, it does not affect their taxes on any of their regular income. That's the little known fact. People think that this stuff pushes you up the tax brackets, and it does not. A bit ironically, if the SCHD was held in a traditional IRA, you would actually owe at least 12% taxes when you take the money out. Because traditional IRAs don't discriminate on the gain type, so interest, dividend, price appreciation, it's all the same. It's just a gain that when you take the money out of your traditional IRA to live on, you'll owe taxes at your current marginal tax rate. So that would be as if you receive more Social Security income or pension income, that stuff that does count as ordinary income. So just to summarize, most people in retirement, unless you have a lot of income flowing in retirement, most people will pay $0 on their taxes from qualified dividends from things like SCHD, DGRO, VIG, VU, VTI, VGT, QQQM, the list goes on and on. On the flip side, income received from high yield savings accounts, money markets, T-bills, REITs, and the majority of the income from JEPI and JEPQ are non-qualified dividends. This means that they add to your ordinary income, will be taxed at the higher rate, and they can push you to a higher tax bracket. How covered call ETFs work. JEPI and JEPQ are the JP Morgan Premium Income ETFs. They use two methods to produce income for the investor. They buy and hold US stocks based on their underlying index. In the case of JEPI, it's the S&P 500, and JEPQ is based on the NASDAQ 100. Two of the best, probably the two best indexes in my opinion. And then for the majority of the income, they sell covered calls against those holdings. These two ETFs have a higher floor, but a lower ceiling versus the indexes that they're based on. What happens is the fund managers of JEPI and JEPQ will sell call options to a potential future buyer of the stocks. Someone will pay for the right to buy the stocks at a set price in the future. So let's say a stock is worth $100 per share. The person may pay a $2 premium for the right to buy the stock at $110 per share over the next month. If the stock shoots up to $130 per share, then the buyer will be able to execute the purchase price of $110. Therefore, we, as the holders of JEPI or JEPQ, would have lost $20 per share, thus lowering our growth potential. But the premium income goes directly into our pockets, and if the stock never exceeds $110 by the set date, the option will expire, we keep the stock, and more importantly, we keep the cash from the contract. This is how these ETFs produce those juicy dividend yields compared to the index that they're based on. Over the long term, the indexes that they're based on have a much higher probability of producing greater total returns. QQQM and VU will very likely outperform JEPQ and JEPI respectively over many decades. But that trade-off of getting that higher yield is worth it to most retirees. Growth ETFs versus covered call ETFs. It's time to analyze a few different retirement scenarios, and I'm hoping that one of these scenarios will resonate with you if you're in retirement or close to. Before we jump in, I want to address something that I received a lot of pushback on my first video about JEPQ. I use 0% dividend growth for my base assumption with JEPQ. And a lot of people said, whoa, that doesn't make sense because the assets that it holds do pay dividends and they've grown at around 10%, which is what the NASDAQ has grown at over the last few years. And while it's not entirely based on the options income, we can all agree that that section of the dividends will have a 0% growth long-term over the years. Sometimes it's high, sometimes it's low, depending on the volatility of the market. But much like a high yield savings account, there won't be a long-term trend. Like if we zoom out 50 years, it'll be about zero growth. And I know some people are hating on JEPQ right now. Its last 5 dividends are down 27% compared to a year ago for each one of the monthly dividends. But again, the market's been less volatile, so I'm not gonna hold that against JEPQ. I think it's just safe to assume about 0%, all things considered. And for the record, about 8.5% of the dividends are qualified dividends based on the underlying holdings, whereas the other 91.5% of the dividends are from the premium income of the options. And I base that math on my personal tax return because as a JEPQ holder, I received a form that broke it down for me. This means the dividend growth rate is below 1% if you break down the weighted average. But I'm going to use a 1% growth rate instead of 0, just to give a little more love this time to JEPQ and JEPI. I like to be conservative in these estimates, but YOLO. Let's hop over my screen and mess around with the dividend projector tool. And this one's out there for all the members of the channel on the shared Google Drive. This is a copy of the dividend projector Google Sheet that's out there for the channel members for you to use for your investments. And FYI, anything that's blue is what we need to manually change on the spreadsheet to make it work. And what I've done is I've plugged in some example tickers just for these scenarios in retirement. And you'll see I have some growth ones down here. We're mostly going to focus on these dividend growth ETFs and these covered call ETFs just to show the difference. But for those people that have a big portfolio value, you'll still want to focus a little bit on growth ETFs as well in retirement. So we'll get into all that. We'll just, as we plug in values of different scenarios of each of these holdings, we'll see what percent of the portfolio it is. And right here I have the trailing 12-month dividend payment. So these are updated as of yesterday, March 18th. So this is the dollar amount that each of these tickers have paid over the trailing 12 months. It's good to use this because these prices here are live. So this will automatically keep the dividend yield up to date, because the dividend yield is simply this trailing 12-month dividend divided by the price. So this will dynamically update for you. And then these dividend CAGRs, as I mentioned before, I'm using 1% CAGR instead of 0 for the covered calls. And then for SCHD and everything down the line here, for all of these holdings, this dividend CAGR is the lower of the 5-year and the 10-year CAGR. So for example, SCHD's 5-year CAGR is 13.05% and its 10-year is 11.39. So I used the 10-year. Okay, in this first scenario, we're going to say you have $500,000 to invest for retirement. And let's say you need $5,000 a month to comfortably get by. So we're going to see our yearly dividends here once we plug numbers in, and we're going to see our monthly dividends. This is just 2024, it's current, so it drops this information down to here, and then it starts growing based on the dividend CAGR, and inflation for purchasing power, PP, will be here. So we'll get into all that. But let's show an example of why SCHD does not work for someone that doesn't have a huge portfolio value. So let's say you have $500,000 to invest and you put every penny into SCHD. So we're putting all 500,000 into SCHD with a 3.36% starting yield. And it looks like it gets us $16.8 thousand of dividends per year. And you'll see that number drops down to here. So purchasing power is, of course, this amount, because this is the year we're in. But you're probably not going to be able to get by on $1,400 a month, especially before that Social Security kicks in. So what you'll need to do in a situation like this is we'll probably need to say hello to, let's just try 250,000. I'm doing these on the fly, 150 and 100,000. Let's try this split of our $500,000 portfolio. Now all of a sudden our weighted yield is 7.49%. Our growth is way down at 3, so it won't grow as much in the future, but you're basically keeping up with inflation with your purchasing power. You're really close, and you're pumping out $3,100, which may not be enough to get by yet. So we're gonna say, okay, we just need yield here. We don't quite have the dollar value. Until Social Security kicks in, we need to bridge that gap with a high yield. So you could take 500,000 and put it all into JEPQ, get that juicy 9% yield. And if you can't get by on $3,700 per month, then you can't retire yet if your goal is 5,000 here. So you really got to think, what do you need to live and survive? And don't forget, your other sources of income will obviously help out. So you'll just need to bridge the gap of the income need to get you by each month. And then with the right investments, this will grow. See, for example, with this 1% CAGR, say you needed about $3,700 to get by. This $45,000 of dividend income in the current year will pay you that $3,700 a month. But the purchasing power per month, as you account for 3% inflation over the years, as you can see, you're going down. You're only having less money. So the actual dollar amount is up, but the purchasing power is getting eaten away by inflation, and you're effectively having less and less to live on. That's where JEPQ and JEPE, producing this random, in a sense, premium income from call options, it'll sometimes be high, sometimes be low, can get you over the years. Let's do $1 million. That's a more standard one. Let's say you put all 1 million into SCHD. Realistically, if we need 5,000 a month to get by, you only have $28,000 a month. Now it's gonna go way up. You see your dividends are exponentially going up compared to the covered call ETFs because of this 11.39 dividend growth rate. So that really adds up, but your purchasing power still doesn't get to that 5,000 until 2032, and that's not gonna do. So if we wanna get by with $5,000, that's where you need to start playing around. And again, I haven't done this coming into it. Let's just say we go SCHD with 500,000 and JEPQ with 500, or let's do 250 each. 250 of JEPQ, 250 of JEPE. Now all of a sudden, ooh, you're almost up to that 5,000. So we're gonna drop this to 450,000, and we're gonna raise this one to 300,000. See, now we're at that 5,000 we need per month to get by, and we're going to beat inflation, because what is happening here is we have enough of a dividend growth ETF to get in there and get that weighted 5.68% dividend growth when you take the weighted average of these here with a sum product. So this is beating inflation. So you're good to go for the future, and you're good to go now because you're getting that $5,000. And now when Social Security kicks in later, you're going to want to put more. You know, eventually you might be able to start putting money into, we're just using SCHD here. Eventually you might be able to do, you know, $800,000 to SCHD, and you only need the yield of $100,000 each of these. So now your growth rate's 9.3%. You have a 4.36% yield. And now, you know, let's say Social Security kicked in, so you only need $3,500 a month. But then look how you exponentially grow as the years go by. In 20 years from now, in 2044, you'll be producing $258,000 of income a year, which comes with 21.5K a month, which is like 11.7K in 2024 dollars when you account for the 3% inflation. The more of these growth options you have, the better you're looking in the future. But in the present, you need to bridge that gap. That's sort of the whole point of this thing. It's probably going to be a combination of these things. It's key to remember that the dividend income from JEPE and JEPQ will have negative tax implications compared to qualified dividends. My goal is to retire on quality dividend growth ETFs if I have the portfolio value to produce the necessary income short term to get the ball rolling. I'm focused on smashing inflation and increasing my lifestyle long term in retirement. But if I'm not quite there at first, I will sprinkle in some high yielding options just to get me over the top in those first few years. The best solution for most situations is probably a healthy mix. Thanks for watching this one to the end, and I actually plan to drop a video regarding REITs in the near future, my thoughts on those. Okay, my camera just tragically died, and I really hope I didn't lose all this. Anyway, I was at this part. Thank you so much for watching, and I will see you here each and every Sunday, and usually on a Thursday. Hope I'm not gonna have to do this all over again. Peace.